Hello and happy Thanksgiving 2015. Welcome to our ACA IRS Reporting Thanksgiving Day Parade. If you love Thanksgiving, love the Macy's Parade, love American icons, and don't love ACA IRS reporting, you will enjoy our short ACA IRS Parade. A few things to keep in mind before our ACA Parade starts. As you know, ACA IRS reporting has many moving parts. As a result, we're going to be hopping around a lot. Given the complex nature of all of these moving parts, there's a lot of information to soak up. We'll do our best to keep the content informative, yet light. Let's face it, ACA IRS reporting is a big revenue play for Uncle Sam. I was told that Uncle Sam has budgeted about $50 billion a year for fines and penalties. Yes, $50 billion annually related to healthcare non-compliance. And guess what? IRS reporting is part of that. Separately, I was also told that the IRS has hired thousands of agents to police and collect fines and penalties wherever they are due. When combined, the individual mandate and the employer mandate will enable Uncle Sam to snoop and start collecting revenue due to non-compliance. We all know that ACA IRS reporting is complex, and there are a lot of moving parts. I cannot emphasize the importance of reporting accurately. Accuracy comes in many flavors, including, but not limited to, plan type, eligibility, offers of coverage, enrollment, series codes, affordability, and covered individuals. While your nose won't grow if you report this incorrectly, your fines and penalties certainly will. So let's talk about those fines and penalties. If you have over 50 full-time equivalent employees, then you have to report. And even for employers with less than 50, if your company has other businesses, and if the total FTEs across all companies is 50 or more, guess what? That's right, you have to report. And fines and penalties include 1. Penalty A, aka the sledgehammer, which is a $2,000 penalty is imposed for every employee enrolled in the plan if less than 70% of the eligible employees are offered coverage. And it's important to note that this is changing from 70% to 95% in 2016 and beyond. There is not a lot of wiggle room here. Penalty B, which is $3,000. And the $3,000 applies if the plan is not affordable, i.e. the premium for the lowest price plan for single-only coverage must be less than 9.5% of income. And it's also important to note that there are 3 different safe harbors here, which you can look up at your own time. There's a penalty for non-issuing a 1095-C of $250 per form. And there's also a penalty for issuing inaccurate 1095-C forms, which is also $250. And of course, there's an even bigger penalty for not filing at all, and that's big. Really, really big. So how does an employer win at this, you may ask? As Peter Drucker, the great management guru, says, the best way to solve a problem is to prevent it from happening. And while we can't stop the ACA, nor the IRS, we can be proactive and figure it out. And yeah, you better hurry up, because there isn't much time left as the ACA IRS forms are due by the end of February 2016. So here's a simple question to ask. Do we have a strategy? Are we going down the right track? Please allow me to call your attention to where this balloon is being handled. You'll notice here the balloon handlers are practicing in a parking lot before the big parade in New York City. Practicing is something all employers should be doing, as you don't want to get it wrong. And if you do get it wrong, the cost for non-compliance is not an option. Not only are these fines material, but they're not tax deductible. In fact, you may need to speak with your banker about you're getting a line of credit or getting a loan to pay them if they're due. Oh, and by the way, Uncle Sam doesn't really care where the money comes from, as long as the money shows up. So, enough about fines and penalties, and in the spirit of getting things done on time and within budget, the best way to start is to ask questions. Be curious. Don't be afraid to ask questions such as, have we identified every eligible employee? Have we made a qualifying offer of coverage to every employee? Do we have all the HR, payroll, benefits, and leave data? Do you have a vendor to prepare and distribute these forms and handle the IRS submissions? If not, call your broker, call your accountant, call your payroll company. You can call us too. So not surprisingly, there are a lot of rules here. First of all, let's talk about who needs to get a 1095-C form. Here goes. 1. Any active or inactive employee during calendar year 2015 that was A, ACA eligible, i.e. works over 30 hours a week in their measurement period, B, enrolled in the plan regardless of ACA eligibility, or C, worked at least 130 hours in any given month in 2015. And again, this pertains to actives, terms, leaves, COBRA, non-Medicare retirees, and retirees. Also, if you have non-benefit eligible employees, you can choose to use either a look-back method, also known as the safe harbor method, or the monthly method to determine eligibility. Also, components of the look-back method include a measurement period, an administrative period, and a stability period. You will also need an initial measurement period for all new hires in each month throughout the year, assuming a 12-month measurement period. Oh, and by the way, there are other rules too. Clearly, there's a lot of work here, and you'll need to get a lot of data to get the job done. You'll need to identify the different places data live and spin a web to get it done. Given everything that we've talked about so far, I'm not surprised if you've been worrying about this a little bit. If you're like most people, you've probably been worrying about this for a long time, and even hoping that it would go away. And much like Charlie Brown, you haven't been able to catch the ACA IRS reporting football. Well, it's time to stop worrying, and now it's time for action. A great way to start is to start reviewing your data. You can do it one piece at a time. Think of your data as Mr. Potato Head. Perhaps a better name is Mr. Poe Data Head. LOL. You can have a payroll data head as a base, benefits data eyes, health insurance data mouth, and so on. Before you know it, you'll have a complete head. So, how do you take all your data and turn it into 1095-C forms and IRS reporting submissions? You'll need technology, really, really good technology. Technology that helps validate your data, technology that helps combine your data, technology that turns your data into those series codes. Well, I apologize for the shameless self-promotion, but we have that technology, and we're also pretty good at handling human capital data management as well. We'll be happy to have an exploratory discussion with you, and if not, no worries, please keep listening. You may be thinking, I've got this under control. We have benefit plans that have minimal essential coverage and have minimal value. We have plans that are affordable. We have data. We have a powerful payroll or HR software. We have IT professionals. We have a broker or a consultant or an accountant, an advisor. We can make this happen. I hope you're right. The last thing you want is a cat-in-the-hat scenario where things appear to be pretty good at first, but create incredible chaos shortly thereafter. To that end, we all know and love our good friend, Fred Flintstone. Yabba dabba doo! But here's a question. Does your ACA IRS reporting technology actually have an engine? Or is it like Fred Flintstone's car, where Fred has to use his feet to get his car to move? And if you look under the hood or look under the cover of most ACA IRS reporting software tools, there is no engine and there's no transmission. All of those Part 2, Line 14, and Line 16 series codes have to be calculated manually for each covered individual for each month. That's a lot of manual work and a lot of risk. Speaking of risk, in the event you do get audited, you will need spinach, a lot of spinach. Given the expected level of fines and penalties Uncle Sam is banking on, coupled with the number of new agents that have been hired by the IRS, this is serious business. The stakes are high. What happens when the IRS comes knocking on your door? For starters, you'll need an audit trail. You will need an audit trail that is comprehensive and accurate. You will need to be able to show documents, including but not limited to how you determined eligibility, proof that offers of coverage were made, proof that non-participating employees actually waived coverage. This will be a fight. Quite frankly, a fight that could have been avoided if the correct forms were sent out on a timely manner. And just to provide you with a different perspective, the accounting and legal professions are counting on the fact that employers will get fines and penalties as they are actively building and fortifying their controversy practices. And no surprise, this will likely cost a lot of money. But the good news here is this particular expense is tax deductible. So, what's the big takeaway here? Unless giant fines and penalties are merely peanuts to you and you want the IRS in your business, doing nothing is not an option. In sum, in this contest, we are all underdogs. While we may not be as lovable nor as humble as the original Shoeshine Boy, it's time to activate your superpowers and start your ACA IRS reporting journey. On behalf of the team at HR Best Practices and ACA Managed Services, we thank you for your time and wish you and your family a wonderful holiday. Thank you.